Let's now look at the sector breakdown of VYM so that you can get a better understanding of where your money will be going if you decide to invest in it. Also, this might give us a bit more of an insight into the way the fund works since, as I already pointed out, not everything is clear with this ETF. The first sector is financials at almost 20%. The financial sector includes companies related to banking, insurance, investment, and financial services. These companies provide services such as loans, savings accounts, insurance policies, investment opportunities, asset management, etc., etc. The financial sector is generally considered cyclical because its performance is closely tied to the broader economy and it tends to do well during periods of economic growth, but may face challenges during economic contractions. This is because during economic expansions, banks tend to see higher lending activity and profitability, while investment firms benefit from increased investment activity. However, this sector can be vulnerable during economic downturns, especially if there is a financial crisis because of reduced economic activity, loan defaults, and falling asset values, all of which can impact financial companies negatively. Big companies in the sector include JP Morgan Chase, Visa, Morgan Stanley, BlackRock, etc. The financial sector is a sector I'm personally neutral on as I don't personally have a big exposure to it. However, it being about 1/5 of the ETF is not something I like. There are two things that have always worried me about the financials. First, when it comes to banks, they are entirely dependent on trust, and literally one bad piece of news or one tweet by a famous person can bring the whole thing down if people decide to withdraw their deposits. It's not like a Microsoft or a Procter & Gamble, which sell products or services people use and need every day. And the second is technological change. Blockchain technology or central bank issued digital currency can flip the whole business model of an asset management firm or a payment processing company upside down. So, to sum up, even though there are great companies in the sector, I just don't feel comfortable with that big of an exposure. Second sector is consumer defensive, also known as consumer staples, at 14.5%. The consumer staples sector includes companies that produce everyday essential products that people use regularly, like food, beverages, cleaning supplies, tobacco, and basic household items. Consumer staples are considered defensive because people need these products no matter what the economy is. I hope you still brush your teeth and wash your dishes even if there is a recession, right? Big companies in the sector include Procter & Gamble, PepsiCo, Coca-Cola, Unilever, and others. I personally like this sector a lot and I like to see it as a bigger part of the ETFs I invest in. It is very resilient and gives you a steady growing stream of cash without a lot of volatility. So I like the fact that it is the second biggest sector of VYM. Next is healthcare at 13%. The healthcare sector includes companies that make medicines, medical devices, and provide healthcare services. For obvious reasons, healthcare is primarily considered defensive, which means the profit of the companies is not affected as much by recessions. Its products and services are essential, and the demand tends to stay the same regardless of economic conditions. Obviously, if you're sick, you still take a pill and you don't care if that means that you're not eating out tonight, right? Big companies in the sector include United Health Group, Johnson & Johnson, Pfizer, and others. I generally like seeing this sector as a bigger part of an ETF because, as I said, the companies there have fairly consistent earnings regardless of the economic conditions. One thing I don't like about healthcare is that the pharmaceutical industry relies a lot on patents. That means that a company can be on the top of the world this year but have its profit reduced by 50% next year because they are no longer the only producer of a certain drug. That risk, however, is reduced when you own a bunch of them in an ETF because you are not reliant on a single company's medical breakthroughs. The fourth sector at almost 12% is industrials. The industrial sector is comprised of companies involved in the manufacturing and distribution of goods and services related to industrial production. It includes companies that make and provide things like machinery, airplanes, and construction and transportation services. Their performance tends to correlate with economic cycles, so during economic expansions, the increased business activities, construction and infrastructure development, etc., drive growth in this sector. However, industrials can be vulnerable during economic downturns when demand for industrial products and services decreases. So, basically, it is one of the sectors considered cyclical. Its performance is closely tied to the overall health of the economy, and it tends to do well during periods of economic growth, but may struggle during recessions or economic contractions. Big companies in the sector include Caterpillar, UPS, Boeing, and others. The sector is a bit of a double-edged sword. It is great because during good times it will probably contribute to good results for the ETF, and it means that the fund will benefit from the onshoring trend in the USA and the decoupling of the supply chains from China. However, it also means that the earnings of the companies in the top sector might suffer a lot during a recession, which will mean weaker growth for the ETF. I mean, just take a look at the earnings of one of the top industrial companies, Caterpillar. Fifth sector, at 11%, energy. The energy sector involves companies that produce and distribute energy resources like oil, natural gas, and electricity. It includes industries such as oil and gas exploration and production, renewable energy, energy transportation like pipelines, etc. The oil and gas industry's performance is closely tied to the price of oil and gas and also to the demand for these resources, and so it's highly cyclical. When the economy is slowing down, factories produce less products, people travel less, and so oil and gas companies make less money. So in general, the sector is considered cyclical. An exception to that are the pipeline companies, which offer a lot more predictable cash flow due to their long-term contracts that are often not connected to the price of oil and gas. However, sometimes their cash flow is dependent on the volume of the products going through the pipelines, meaning that if the demand slows down, they will suffer too. Major companies in the sector include Exxon, Chevron, Shell, and others. Unlike what the environmentalist crowd wants you to believe, these companies are not inherently bad and their business isn't going away anytime soon in the next decade. So I feel pretty okay with them being such part of the ETF. Sixth place, with almost 10%, the technology sector. The technology sector includes, you guessed it, companies involved in developing, manufacturing, and selling technology-related products and services. Businesses in the sector create products like smartphones, computers, software applications, internet services, semiconductors, etc. The technology sector is usually considered cyclical as it can experience ups and downs with economic cycles, but it often provides opportunities for long-term growth due to the technological innovation. On top of that, some of the companies in the sector are so big and have basically a monopoly or duopoly on a certain market that even during recessions, their profits are relatively safe. Big companies in the sector are Apple, Microsoft, Nvidia, and others. This sector is the biggest component of ETFs like the S&P 500 or the Nasdaq 100, and you can see that it is currently only around 10% of VYM. Having in mind the recent developments in AI and the growth of a few big tech-related stocks, it is no wonder that the Vanguard High Dividend Yield Fund has underperformed these ETFs. However, that doesn't necessarily make it a worse investment. It is just a different ETF created for a different purpose. The technology sector is not known for its big dividend yields or dividend-oriented policy because these companies need to reinvest a lot of their capital into developing new technology to stay competitive. Hence, you won't see it as a top sector in a lot of dividend-oriented ETFs, regardless of the fact that it is the biggest sector in the economy. Whether that is good or bad, you decide. I personally am a bit torn about it, as I know that this is the quote-unquote sector of the future with the biggest potential growth. However, at the same time, I am a cash flow investor, and so locking my capital in sectors and companies that don't pay me a dime for 15 years seems stupid to me. But everyone is different, and it is up to you to decide for yourself whether you want bigger exposure to it or not. If you do, this ETF is probably not for you, as by design the screens won't allow a lot of tech companies. If you're getting value out of this video, click the like button and also subscribe to the channel by clicking the subscribe button and then the notification bell. That way you will be directly notified when I release new videos instead of relying on the algorithm to show them to you. The amount of engagement I get shows me what types of videos the audience enjoys, so I know to make more of them, and so this feedback is really valuable to me and to the channel as a whole. The seventh biggest sector is the utilities sector at almost 7%. Well, what can I say about utilities? We all pay them, none of us can go without them. The utilities sector includes companies that provide essential services related to electricity, gas, and water. The sector is considered defensive and stable because it provides essential services that people and businesses need regardless of economic conditions. Demand for utility services remains relatively constant, making the sector less sensitive to economic ups and downs compared to other sectors. As an income investor, this is why I like to see a bit bigger allocation in it. However, have in mind that this is one of the slowest growing and most regulated sectors of the economy, so don't expect wonders from it. It's a slow and steady cash cow that will generally keep you afloat during bad times and lag sectors like tech or industrials during good. The 8th place is for the consumer cyclical sector, also known as consumer discretionary, at 6.6%. The name pretty much explains it. The consumer cyclical sector includes companies that provide products and services considered non-essential or wants rather than needs. Think luxury items, travel, entertainment, etc. Consumer cyclical companies are, surprise, highly cyclical, meaning their performance is closely tied to economic conditions. During economic expansions, people tend to spend more on discretionary items benefiting this sector. However, during economic downturns, consumers cut back on discretionary spending, impacting the sales and profitability of the companies. Big companies here include Amazon, even though I personally think it is a technology company, but whatever, Tesla, Nike, etc. For me, being a more conservative dividend investor, I don't like to have this sector as a big percentage of my ETFs. However, it provides a good opportunity to take advantage of a booming economy coupled with high consumer confidence. So this percentage of VYM being in cyclicals is fine with me. Okay guys, just a few left. Next is communication sector with 3.72% of the VYM ETF. The communication services sector includes industries such as telecommunications, media, including social media, broadcasting, and others. The communication is not classified as a typical defensive sector, however, it is less cyclical than most of the others because it provides essential services. Regardless of whether there is a recession or not, very few people nowadays can stay even a day without phone and internet. So the demand for their services is pretty stable. However, the companies need to adapt to constant changes in technological environment. For example, a business like AT&T might have been the biggest business in the sector 1 decade, but then social media comes along and suddenly Meta is a far bigger company because of a profound technological change. Last sector with 2.45% of the fund, basic materials. The basic materials sector is comprised of companies that produce, obviously, materials. It includes industries such as mining, chemicals, forestry, and metals. The sector is highly cyclical, meaning that its performance is closely linked to economic cycles. During economic expansions, there is increased demand for raw materials in construction, manufacturing, and infrastructure development. Then, during recessions, companies can face challenges when demand for these commodities decreases because of less economic activity. Also, businesses in the sector are highly sensitive to the price of commodities, which adds additional volatility to them. You can often see companies with very high dividend yields in this sector, but you have to be ready for them to get cut by 40% next year and then go up by 60% in 3 years. Big companies include Rio Tinto, BHP Group, Glencore, and others. The sector is not for investors who rely on dividends to pay their bills. Because of that, I am generally cautious with it. However, it plays a vital role in our society that is not going away, and arguably with the push for green energy, the basic materials companies will only get more important because of the exponential need for lithium, copper, nickel, steel, etc. Because of that, I would personally like to see this sector a bit higher in an ETF than it is in VYM. And the last sector, oh wait, I'm really not sure what is going on here. Real estate was supposed to be excluded from the ETF, however, here it is at 0.01%. I suspect this is the value of some brick that has been forgotten in the Vanguard's office room where the managers of the ETF work, and so it is counted as an asset. Who knows? If you would like to see my top 4 stocks and ETFs I invest in for the current economic and geopolitical environment we are in, go to the link in the description and I will send them to your email for free. The report will always be up to date, regardless of when you are watching this, because I am constantly updating it. This is just a small part of my complete guide I did on the VYM ETF. To check the full review, go to the video that should have appeared on your screen right now or to the description below.